Most crypto investors make one big mistake. They don't rebalance their crypto portfolio. If you skip rebalancing, you could miss out on explosive gains. Or worse, you could watch your entire portfolio crash. So in this video, I'll show you the most effective way to manage your crypto portfolio that can seriously boost your returns. So to find the most efficient portfolio strategy and to find the most efficient way to manage your portfolio over time, I backtested based on real historical data. I backtested hundreds of strategies to find the most optimal, the one that will maximize your return while minimizing your risk. And so all of this, I did it by analyzing the real historical cost of crypto over time. So I took here 3 examples. I looked at the price of Bitcoin since 2021. That's the price in blue here. I looked at the price of Ethereum. That's the one that is shown in orange. And I also looked at the price of Solana, which is shown in green here. So all of those prices are shown on the logarithmic axis here so that you can compare the price action of those 3 coins. And as you can see here, the key aspect of this is that overall, most cryptocurrencies tends to increase and decrease in value almost at the same time, but not exactly. For example, typically Bitcoin tends to increase first, and then Ethereum tends to increase second, and then altcoins like Solana tends to increase first. So based on this, I will show you what's the most efficient way to manage your portfolio. So if you have several cryptocurrency like Bitcoin, Ethereum, or other types of altcoin in your cryptocurrency portfolio, I'll show you the best way to manage this over time. So for this, let's take an example. So let's assume that you buy in 2021, in January 2021, let's assume that you buy $7,000 of Bitcoin, $2,000 of Ethereum, and $1,000 of Solana. So that would give you a portfolio that looks like this, a pretty safe portfolio where the majority of the portfolio is placed in a safe asset like Bitcoin. The remaining is placed on more risky asset like Ethereum, and probably even more risky like in Solana. So that would be a typical portfolio. And let's see how this portfolio, how the value of this portfolio would evolve over time if you had invested in those cryptocurrency with this allocation in January 2021. So here on this plot, I'm showing you the value of the portfolio as it evolved over time since 2021. So as you can see here, your portfolio would have increased a lot until late 2021, and then it would have dumped a lot and almost go back to its initial value in 2023. And then your portfolio would have increased a lot again in 2024 and 2025. So if we look at the value and the return of this portfolio, so you would have invested $10,000 initially in 2021. The final value of the portfolio in late 2025 would now be $162,900. So that's a return of 1,500%, more than 1,500%. So that's more than a 16x return. So it's pretty good, and it's a pretty good strategy to buy crypto because it tends to increase its value over time. So this strategy of just buying a pretty safe portfolio dominated by Bitcoin, but still with some exposure to some altcoins like Solana, would have performed very well. But as you can see here, there is one major risk, one major drawback is that at any time, your portfolio runs the risk of completely dumping and going back to its initial value, or worse, decreasing even lower than your initial investment. So as you can see here in 2023, your investment would be worth almost the same value that you have invested. So you would have essentially wasted 2 years. You have wasted 2 years of gains. All the gains that you had realized in the first year would have melted like ice under the sun. And most of your return would actually be coming only since 2023. So is there a better way to avoid that? Is there a way to avoid the downside risk of losing the value of your portfolio? Well, it turns out that there is, and for this we need to understand like what is the risk here. So if we look at this portfolio in more detail, if we look at the contribution of each coin within this portfolio, so initially when you look at in 2021, when you initially build your portfolio, so you have 70% of Bitcoin, that's what is shown in blue here, 20% of Ethereum, that's what is shown in orange, and 10% in Solana, which is shown in green. And then what this diagram shows is how the fraction of each of those three coins changes over time as the value of those three coins changes independently from each other. And as you can see here, the issue with this approach, if you just keep a static portfolio that you don't rebalance over time, is that because Solana has increased so much between 21 and 22, around early 2022, your Solana position completely dominates your portfolio. In 2022, Solana would make up more than 80% of your portfolio. And the risk with that is that you would have benefited from the explosive growth of Solana. But at this point in 2022, now Solana would completely dominate your portfolio. And so that's a risk concentration. That means that you have lost the diversity of your initial portfolio. You have lost the fact that Bitcoin is a much safer asset to hold, and that you should always have a portfolio that has a majority of Bitcoin to minimize the risk of having more risky asset like Solana suddenly dump over time. So it's a key aspect in portfolio is to manage the risk and to prevent having one of your assets completely dominating your portfolio, which runs the risk of then greatly reducing your portfolio if this risky asset starts to dump over time. So for example, if we look at this portfolio here, so in 2022, everything looks great. Solana has increased a lot. Solana has seen an explosive growth. But now, because of the fact that Solana completely dominates your portfolio, now when Solana starts to dump, and Solana really dumped hard until 2023, it's affecting a lot your portfolio because Solana is now making such a big portion of your portfolio. So one way to mitigate that is to rebalance your portfolio. So that's an important strategy when you have a portfolio made of different cryptocurrency. Rather than keeping your portfolio static and letting the size of your different allocation evolve on their own, what you can do is to periodically rebalance your portfolio. So let's see what it looks like. So let's assume that you start with a portfolio where you buy some Bitcoin, maybe some Litecoin, some Ethereum, etc. And then, so as you let this portfolio evolve over time, some of those cryptocurrency will increase in value. But some will increase in value faster than others, and maybe some of those cryptocurrency will actually drop in value. So at this point now, you would have a new portfolio where the fraction of each of those crypto in your portfolio would not match your initial allocation. So at this point, if you want to respread the risk, if you want to prevent having one of those assets really dominating your portfolio and really minimizing the risk of having an asset that has such a big fraction of your portfolio, what you can do is to rebalance it. That means that you will take all the cryptocurrency that have increased the most and you will sell them to buy the one that don't have increased that much. So you will look at all the cryptocurrencies that are now making a bigger fraction of your portfolio, like Bitcoin in this case, and you will sell it to buy back some of your cryptocurrency that did not perform as well, so that you go back to the fraction of your initial allocation. And so that way you spread the risk and you go back to a diversified portfolio. So now let's see what this looks like. So let's assume that now we are going to simulate the fact of periodically rebalancing your portfolio and see how it's affecting the return on your investment. So for this, I wrote a script here to simulate the fact of periodically rebalancing your portfolio. And again, I'm going to backtest this based on the historical price action of Bitcoin Ethereum, and Solana. So first, let's consider a first case where you rebalance your portfolio every week. That means that every week you relook at what's the fraction in your portfolio of the different crypto in your portfolio, and you sell the crypto that have performed the best over the past week to buy back the one that have performed the least well. And you do that every week so that you go back every week to the initial fraction of your allocation. So if you do that, so now let's see the fraction of the different assets in a portfolio over time. So now, as you can see here, because of the fact that we are rebalancing the portfolio every week, then necessarily the fraction of Bitcoins remains pretty constant, because every week if Bitcoin increases a lot, for example, then you will sell Bitcoin to buy back Ethereum or Solana. So necessarily the fraction of Bitcoins remain pretty constant, close to 70%. The fraction of Ethereum remains close to 20%, and the fraction of Solana remains close to 10%, with just some small fluctuation that comes from the price action of each of those coins every week. So if you do this, if you rebalance your portfolio every week, is it actually helping to return to increase your gains? Well, let's find out. So now let's see what's the value of your portfolio with and without rebalancing. So here in blue here, this would be the value of your portfolio. Again, this is assuming that you invest first $10,000 in January 2021. And so the curve in blue shows the value of your portfolio if you don't do any rebalancing, if you just keep unchanged, if you don't sell any coins or you don't buy back any coins, you just keep your portfolio unchanged. So as you can see here now, if we look at the evolution of the value of your portfolio when you rebalance it every week, which is the curve in orange here, the gains are actually lower than if you don't do any rebalancing. So rebalancing your portfolio every week is actually a mistake. It's going to hurt your gain. And why is that? Because if you rebalance your portfolio every week, you are missing out on the explosive gains of some of your coins. For example, if you are rebalancing your portfolio every week, you would have missed out on the explosive growth of Solana. You would have sold Solana too early. You would not have let Solana explode in its value. And so you keep selling too early, you readjust your portfolio too often, and you keep missing out on the growth of some of your cryptocurrencies. So weekly rebalancing of a portfolio is actually counterproductive. It's hurting your gain. So make sure you don't do that mistake. But that doesn't mean that rebalancing is not useful. But what you need to do now, what I will show you in the rest of the video, is the very best way to rebalance your portfolio. So I will give you the very best, most optimal strategy that will give you the best return based on historical data. And so for this, the way I found out these optimal strategies is by testing a lot of different rebalancing frequency. So what I tested is to test out what happens if you keep rebalancing your portfolio every 7 days, every 14 days, every 31 days, etc., up to every 1500 days. And so now let's see the result. Let's find out what is the optimal way. How often should you rebalance your portfolio? So for this, let me show you those results here. So what I'm showing you here in the red dashed line, this is the return that you would get. This is the value that your portfolio would have if you just don't rebalance at all. So this is our baseline. What we want to do is to find a strategy that gives you a higher final value than this baseline, which is basically you doing nothing and just letting your coins change in value on their own without any rebalancing. So this is going to be the baseline here. So now what I'm showing in blue here, this is the value, the final value of your investment as a function of how often you rebalance your portfolio. So this x-axis here is the rebalancing frequency in days. So for example, if you rebalance your portfolio every single 7 days, every week, that's going to give you this point here. If you rebalance your portfolio every 1,000 days, that's going to give you this point here. Right? So let's find out what the results are. So let's start with, let's go step by step. So if you rebalance your portfolio too often, like every 7 days, every 14 days, every month, etc., as you can see here, the value of your portfolio is actually lower than if you don't rebalance at all. So again, rebalancing your portfolio too early means that you keep missing out on the growth, on the explosive growth of some of your coins. So it's actually counterproductive. But now if you rebalance your portfolio not frequently enough, then you risk having some coins growing so much that they dominate your portfolio, they create a huge risk, and once they start dumping, then it's affecting your portfolio disproportionately. So again, now if you don't rebalance your portfolio often enough, then it's also going to hurt your return, because you're going to have some of the coins pumping a lot and then dumping a lot, and you would not have taken profit meanwhile, and so your portfolio would increase a lot and then it would really decrease a lot, because of the fact that now your portfolio would be dominated by very risky assets like Solana. And if you just rebalance your portfolio every 1,500 days, for example, then it essentially means that you are not rebalancing. Like if your rebalancing frequency is so large, it's almost the same as if you are not rebalancing at all. So the value of your portfolio would just become very close or equal to the baseline value of not rebalancing your portfolio at all. But as you can see here, there is a sweet spot. There is a sweet spot where you can see a maximum final value for your portfolio. And this sweet spot, you can obtain it when you rebalance your portfolio every year, when you rebalance it every 365 days. As you can see here, rebalancing your portfolio every year is what will give you the portfolio that has the highest final value. So let's try to understand why this is the case and how this annual rebalancing works. So for this, let's look at the fraction of the different coins in your portfolio if you rebalance it every year. So you would start again in 2021 with 70% Bitcoin, 20% Ethereum, and 10% Solana. So for 1 year, you would let those coins evolve, let their value change over time, and you would not rebalance it until 1 year later in 2022. And so if you do that, you are not rebalancing too often, which means that you are capturing this explosive growth of Solana, which has increased really a lot between 21 and 2022. But now in 2022, what you would do is that you would sell some of your Solana to buy back some Ethereum and some Bitcoin. And so at this point in early 22, you would go back to 70% Bitcoin, 20% Ethereum, and 10% Solana. And now the value of you doing that is now that Solana is actually going to decrease and dump a lot, because now Solana would make up only 10% of your portfolio, despite the fact that Solana has been dropping so much. It's not affecting your portfolio so much, because now Solana is back to being a small fraction of your total portfolio. So this is really the value of rebalancing with the most optimal frequency, is that not only you capture the big gains of some of the most risky and volatile coins, but you also give enough time for those coins to capture those gains before you sell too early, but also you eventually start selling the one that have performed the best, so that you minimize your downside risk and you limit the risk of having some of those assets drop a lot, right? And then in 2023 again, you would rebalance your portfolio to go back to about 10% Solana, 20% Ethereum, and 70% Bitcoin. And now, again, you would capture the fact that Solana would increase a lot. In 2024, you would again rebalance your portfolio to sell some of your Solana to buy back some Bitcoin and some Ethereum. And so eventually what you would do on the long term is that every year, the fraction of each of your coins would go back to the initial fraction of your allocation, and you would benefit from those explosive growth, but without risking those coins to dump back to a very low value. So if you look at the evolution of the value of this portfolio after rebalancing it every year, so this is what you can see here in orange. Of course, for the first year, the value of your portfolio, whether you rebalance it or not, remains exactly the same because you would just not rebalance it at all until the first year. But now in 2022, because of the fact that you would have sold the best horse, so the Solana coin, now your portfolio would not dump as much as if you have kept this high allocation of Solana. And again, in 2023, you rebalance your portfolio, so you buy back some of the Solana. And again, you benefit now from the explosive growth of Solana and of the other crypto. And you rebalance it in 2024, you rebalance it in 2025. And eventually now, if you look at the final value of your portfolio, you would have a return of almost 3,000%. So that would be a 31x. So that's a return that would be 2 times higher than if you did not do any rebalancing at all. So this really shows you that by really rebalancing your portfolio with the optimal frequency, that is to say, by rebalancing it every year, you can really protect yourself from the downside of your most risky coins, and you can really still benefit from the rapid growth of some of your coins. So there you have it. So if you, based on those historical data, the most optimal way to manage your portfolio is to rebalance it every year. So now if you want to further reduce your risk, if buying such a large amount of crypto and keeping it for 5 years is too risky for you, another strategy is to use dollar cost averaging, or DCA, where you buy every week, for example, a periodic amount of crypto. So if you're interested in exploring the most efficient way to do dollar cost averaging, I've developed the most optimal DCA strategy to maximize your return and minimize your risk. So if you are interested in finding out about this optimal DCA strategy, make sure to watch this video.